Despite all the talk about a possible housing meltdown, the latest price statistics show no major changes. The small dip earlier this year is nothing compared to the big shifts we've seen in the past 3 years. So, get ready for an exciting deep dive into this video as we uncover the truth about the potential housing meltdown. Let's jump right in and explore together. We're diving into the realm of house crashes and how you can protect your investments. The world experienced a major event that shook up the economy, including real estate. From March 2020 to June 2022, the price of a median home skyrocketed by a whopping 43%, according to the Case-Shiller Index. This incredible surge was something no one expected. After an impressive 27 months of near-parabolic growth, the market finally took a breather in June 2022, when Shiller reached its peak. Stay tuned as we uncover more insights and strategies to navigate this ever-changing market. Let's protect those investments together. It has risen by 43% since March 2020, as previously mentioned. The tale was finally changing, as prices fell for 5 months in a row, falling 3.6% from their peak. Compared to what happened in previous years, this appears small. For prices to fall to pre-pandemic levels, Shiller will need to drop an additional 28. So what's the story here? Although the 6% drop is barely noticeable to buyers, there is rising evidence that this is the start of another housing downturn similar to the one that occurred in 2008. This is evidenced by the alarming new data that is disclosed every week, such as the most recent case. According to the Shiller publication, prices have now declined for 5 months in a row, which may appear small. Looking back in time, however, we can observe that this type of decrease is incredibly rare. It's fascinating to see how the market has behaved over the years. Since 1986, the Case-Shiller Index has shown that the market rarely drops more than 3%, except for the 3.05% drop in 1990 and the big one in 2008. But here's the twist. That tiny blip on the graph is a big deal. It's a sign that something significant has changed in the markets. Right now, it seems like we're in the denial phase of the crash, with sellers holding firm on prices and creating a bit of frustration for buyers. But you know what's interesting? Builders, those multi-billion-dollar corporations, are the ones who move prices in most markets. They understand demand better than anyone else and have a big incentive to adjust prices. This past quarter, we saw many serious builders lower prices and offer incentives like rate buy-downs to entice buyers. So, while the Case-Shiller graph might not show the full picture, there's some action happening on the ground. Have you ever pondered what may cause a real estate property to fail? Prepare to be astonished and scared as we uncover the truth. The most recent financial reports from builders reveal some rather major market difficulties. So while the effects of these moves may take some time to filter into the existing housing market, these advances in the new home space will have an impact. Consider acquiring an old home and discovering that a new one down the street has suddenly reduced its price by $20. Putting it on par with the old one you were considering will almost surely impact your choice to buy, as there is usually a premium between the existing stock and the new one. New homes are always the ones that anchor prices. Unfortunately, it's still not something that will suddenly erase all of those post-2020 gains overnight. The truth about real estate crashes is that they take a long time to get rolling. Before we do that, we'd love for you to take a moment to hit that like and subscribe button if you're enjoying the content thus far. But at a snail's rate, 1 year from this point in July 2007, the Case-Shiller was down only 1.95, so to put that in context, we are down more in these 5 months than we were the last time in a year, and 2 years past this point in July 2008, we were only down 10%. It would take 5 years and 7 months for the Shiller example to complete its fall, bottoming out in February 2012 after a 27.4% drop, and another 5 years to recover prices to the 2006 peak. It's making the entire process from start to completion a 10-year and 6-month cycle. To summarize, we were attempting to demonstrate with that example that housing values do not fall overnight. It's a gradual process that begins with the builders and works its way down through the market until all of the greed is flushed out of the system, which of course does not happen overnight. The market, on the other hand, has been at a crossroads for decades. In the face of a challenged American ideal of home ownership, our graph, meticulously produced using data from the US Census Bureau, Federal Reserve, and Department of Housing and Urban Development, graphically reveals the basic yet powerful math behind the battle. You won't believe the eye-opening insights we've uncovered about the American dream of owning a home. We crunched the numbers using data from the US Census Bureau, the Federal Reserve, and the US Department of Housing and Urban Development to reveal the truth. It's all about simple math. Join us on this journey as we dive into the dark secrets behind house crashes in the real estate world. But first, let's talk about the impact on your real estate investments. Spoiler alert. It's not as rock solid as you might think. Here's what we did. We traced the median house sale prices since 1997 and calculated the necessary payments, considering a 10% down payment, taxes, insurance, PMI, and average interest rates. Then, we compared this with the median household income to reveal the strain it puts on everyday folks. It's all about understanding the reality behind those numbers. So are you ready to uncover the truth and navigate the twists and turns of the real estate market? Let's dive in together and make smarter decisions along the way. For the sake of simplicity, we've created an affordability chart. All this chart does is show the percentage of monthly income that the average American would have had to pay if he had purchased a typical property that year. It's a measure of affordability, and as you can see, it's been hovering around 39 for the majority of the last 25 years leading up to 2008. This measurement has risen to 46. Buyers and the entire financial system gave up at this point, forcing prices and interest rates to fall. Following 2008, affordability improved for many years, hovering at 35% until gradually creeping back up to the average in 2020. The way those measurements shot straight up and just kept going, it's like a roller coaster ride. Imagine this, the median American who bought a home in 2022 is now paying over 52% of their gross before tax income on the mortgage. That's higher than the relative prices of 2008. Now here's the big question. What's different this time around? Well, the simple conclusion is that this can't continue with the current income levels. History tells us that one of the three tables has to contribute. Incomes are unlikely to rise to catch up, and interest rates are expected to stay elevated. If we believe Jerome Powell's own words, the Fed will continue to raise rates throughout this year. So that leaves us with one variable left: prices. No wonder so many are calling for a crash. It's just becoming unaffordable for regular folks to own a home, even though unemployment is low and incomes have been doing well. In summary, without demand from everyday Americans, maintaining the supply will become increasingly difficult. And once the inventory situation unfolds, prices will inevitably be affected. It seems like what we saw this past summer is a glimpse of what's to come in the coming year, especially when it comes to the builders. In the ever-changing and exciting world of real estate, knowing is like having a secret treasure map. So stay informed, make wise investments, and protect those valuable assets. Knowledge truly is key. If you enjoyed this video and want to see more engaging content like this, don't forget to give it a thumbs up and hit that subscribe button.